Hello, everyone. In this session, we're going to look at our practice assessment 1, and we're going to look at task 4. This is our second part of the recording for the practice assessment 1 from the AAT website for drafting and preparing financial statement. Now, obviously, this question will be the combination of 7 tasks, and we're going to look at all the major tasks with explanation. And hopefully, if you understand it, that will not be very difficult for your exam. One thing you have to remember, the question we are practicing now, we are not going to see the exact same question in the exam, but we're going to look at the same format. Now, for example, the very common technique the AAT exam have, if they give you a practice question here in the practice assessment, where you can see something is true, and in the real exam, that one, the same question will be there, but that time they'll ask you which one will be false. So the very common technique, you can use it. When you do a question, if you know this is true, so you have to know what is the other one, which one can be false. For example, if the question asks you, this is a provision for this question in the practice, in the exam, in the final exam, they'll ask you which one is not a provision or which one is not a contingent liability. So you need to always look at both sides, because in the final exam, they will always do that. All right, so let's have a look at our question number 4. This question we have for 12 marks, and it's a very straightforward question. If we know what is provision and the contingent liability, this question can be very easy for us to do quickly. First, read the question. So we start with our question. It said this task is about the IAS, International Accounting Standard. And it says this task contains part A to D. B Limited is a manufacturer of electrical appliance. The finance director is preparing the financial statement for year ended 31st of December 2011. Remember that always year ending date is very important. So always make an underline or remember the year end date. Has brought the following matter to your attention. We have 2 matters, matter 1 and matter 2. So let's try to understand the both matter. A legal action was brought against B Limited in November 21. That means just before the year end. Our year is ended December. Just before the year end, there's a legal matter raised by a former employee who is claiming compensation for 50,000 for unfair dismissal. Budge Limited solicitor have advised that there is a 30% chance that the claim will be successful. Now, remember, this percentage is very, very important here, because based on this percentage, we have to decide the next step. So what does that mean? That means we need to look at, is that chances less than 50% or more than 50%? So what is the chances that this claim will be successful? Is it less than 50% or more than 50%? Now, if it is less than 50%, we called it possible. And if it is more than 50%, we called it probable. So less than 50% chances to happen, we called it possible. More than 50% chance, we called it possible. Now, if there is a probable, remember that we don't have to keep the provision. So do not keep provision. Do not keep the provision if there is a chances less than 50%. So instead of keeping the provision, what we do, we just make a note. So note to SOFP. So rather than we create the provision on the financial statement, we just show on the note like there is a claim and there is a possibility, and the chances is 30%, or possibility we have to pay the compensation. But we really don't have to keep the provision because it is not very likely we have to pay that. But if it is probable, that is chances is more than 50%, in this case, the treatment will be different. And we have to make provision, on the SOFP. Make provision on the statement of financial position. So you need to remember this technique. If we do that, it will be very helpful for us. So for this matter one, it is less than 50%. It is a possible of the cash outflow. So for that reason, we have to just keep the note. We don't have to keep the provision. The second matter we have here, on 1st January 2011, B Limited entered into a lease for a machine. The company was required to pay an initial deposit, £600, followed by the 3 annual statement, 3,000 each. So 333, they have to pay 9,000, starting on 31st of December 2011. On 1st January 2001, at the beginning of the year, when I make the investment, the deposit, 1st January, so 1st January, very careful with that date. So I put the deposit, initial deposit 600. The present value of the 3 lease payment fall due after the date is 8325. So that's my NPV, net present value. So net present value for the next 3 payments. So I'm going to pay 333, 9,000. So the present value of the 9,000 is 8325. The machine has a useful life of 5 years. Okay. So remember this 600, we don't have to do the discounted factor. We don't have to change this one to the present value because we are in 1st of January. So value of the 600 on 1st of January is 600. Only the next 3 installment, that is 3,000 each, this one we have to change. So because I'm going to make the payment in future. So if I try to see how much is the current value, and that is 8325, it is given. But 600 is always 600 because we are counting on 1st of January and we make the deposit on 1st of January. So on 1st of January, our 600, the value of 600 is 600. All right, the rate of interest implicit in the lease is for 4% per year. So this is the rate of interest, okay. Ownership of the asset does not transfer to B Limited at the end of the lease term. So after the lease, the asset will not be owned by the company. So we need to give the asset back. So it is look like operating lease. It's not a finance lease because if it is finance lease, at the end of the lease period, the asset is belongs to the company. All right. So we need to know what is the question and what to do. One thing we need to know, if we have a useful life of the asset, that is 5 years, and if we have a lease term, that is how many years we need to see, 3 years. So between these two, we always take the lower one, lower of, remember that. Lower of between the useful life of the asset and the lease term. Between these two, we have to take the lower one, that is 3 years, when you do the depreciation. So when you're going to calculate the depreciation, we're going to look at that price, that year, 3 years, not 5, because we took the lower one. And when you're going to show this one on the financial statement as an asset, this asset is not belongs to the company, so we're going to show as a right to use asset. Right to use. Right to use. That means we have a right to use this asset. And the way we're going to show it after the end of the year, because we need to take out 1 year depreciation, we buy on 1st of January, we make the payment. So at the end of the year, that is 31st of December, 1 year depreciation need to take out. So how we do that? So first we need to look at the present value on 1st of January, that is 8325. This is the present value, is the cash flow, cash outflow. Plus 600 is the deposit. Remember that this 600 will be 600 because I'm talking about now 1st of January. So 600 value of the 1st of January is 600. So this too is my cash outflow. Then you have to minus the depreciation. And the depreciation will be based on the amount we have, that is 8925. If we added this to is 8925, this is my value, minus the depreciation. So 8925 divided by 3. Remember that. Do not use the useful life of the asset. Always use the lower one between these two. So if we divide with that, that will give me 2975. 2975. And if we minus 2975, and this amount actually we're going to put on our financial statement when you're going to recognize the asset, that is 5950. So a few things: the net present value plus the deposit minus the depreciation. The depreciation is the lower of between the useful life and the lease period. All right, so this is the first thing. And the next thing we need to know, obviously, like how we're going to use it on our financial statement. This is the value you're going to recognize. The rate of interest is a link with our finance payment. It is the interest. So this is belongs to profit and loss account. All right, so let's have a look. What is the requirement? And we're going to go through with that. But the first matter is to identify whether the legal action should be treated as a provision or a contingent liability at the end of the year. As you already know, it is less than 50% chances, so it is a possible matter. So you're going to say it is a contingent liability. And we need to show on the note to the financial statement because it is not very much likely it will happen. State one reason for your answer. So why you choose it as a contingent liability? So we'll say this is because it is outflow of possible. This is because there is a possible of cash outflow and chances is less than 50%. It's more than enough to get 1 marks. The next one is says state the accounting treatment of matter 1. So what is the accounting treatment? We know that very well. There's 50,000. Just we need to show to the note to the statement of financial position. So disclose to the note to the SOFP, statement of financial position, 50,000. That's it. You don't have to keep the provision. Very simple. If you know it, you'll get this 1, 2, 3 marks in 3 minutes. All right, let's move to the next matter we have. Matter 2, it says calculate the amount at which machine should be recognized as non-current asset in the statement of financial position at 31st of December. So you already discussed that. we need to see how much is the amount we paid. So NPV, that is the net present value, 8925 that we have calculated before. That is the combination of our present value plus the deposit 600 minus the depreciation, that is 2975, and that will give us 5950. And the depreciation always calculated the lower of between the useful life and the lease period. Explain your answer. So they're asking explain your answer. There's 2 marks. You need to explain 2 things. So we'll say machine should initially recognized as a right of use the asset at present value plus the deposit. Number 1. Number 2 will say the lease should be depreciated over the shorter of useful life and the lease period. Between these two, we take the shorter one. So for 2 marks, 2 sentences would be more than enough. Trunk Limited provides gardening services. The company has entered into a 12-month contract for regular garden maintenance work commencing on 1st July 2011. The agreed contract price is 5,000. At 31st of December 2011, T Limited estimated that it has completed 40% of the work required. So this question from revenue recognition, and this covers IFRS 15, and obviously like there are a few more information you need to know about IS, but this question is only for 2 marks. For the calculation, it's not very difficult. So all you have to know, we cannot recognize all the price. We only need to recognize the income that like the work has been completed. Now we completed by this year only 40%. So from the 5,000, need to calculate how much is the 40% of that, and that is 2,000. So 2,000 I'm going to recognize in the financial statement for the year end 30 December 2011. Even though we did not receive the money or we did receive the money, doesn't matter. Remember that we have to always look at how much the completion of the work. If there is some deposit and we take some money advance, the treatment could be different. So you need to make sure you revise this one very well, revenue recognition, because this is very common in the exam. All right, let's move to the next one. The next question we have from the impairment. That's quite interesting question and quite easy if you understand it. So impairment basically the difference between the carrying value and recoverable amount. So impairment is the difference between the carrying amount or carrying value and the recoverable amount. Now, what is carrying amount or carrying value? Carrying value or carrying amount means cost minus accumulated depreciation. And the recoverable amount means 2 things. 1, market value or fair value less cost to sell and value in use. And recoverable amount is the higher of. So between these two, we take the higher one. And this one we call recoverable amount. Now, what is the market value less cost to sell? So for example, if I have an asset and we buy this asset, for example, £10,000, that was the cost. And we use this asset for 1 year. And for example, the depreciation is 2,000. That means the carrying value is 8,000. On the other hand, on the market, if I want to sell this asset now, I can sell it for example, 8,500. And one more zero extra, so 8,500 I can sell now. But to sell this one, I have to pay some commission, I have to pay some advertising, whatever. So let's say there is a cost of 200, so less cost to sell. So I'm gonna get, for example, 8,300 if I sell it now. And if I don't sell it, if I use it in the business, let's say the value is 8,700. So value in use. Rather than sell it, I use it in the business, and that will give me the value 8,700. Now the recoverable amount is the higher of between these two. So it is 8,700. Now, if my carrying value is more than the recoverable amount, and my obviously like carrying value is the value right now we have on the financial statement. So if the carrying value is more than the less than the recovered value, that means the asset has impaired. Now, for example, here my carrying value is 8,000 and my recoverable amount is 8,700. So it is more than the carrying value. So if my recoverable amount more than the carrying value, that means this asset is not impaired. Impaired means like something, the recoverable amount is less than the carrying value. Now here, my carrying value is 8,000 and my recoverable amount is 8,700. So we can say easily this asset is not impaired. Because my carrying value says is 8,000, but in the market it is more than that, or if I use it, it is more than that. So I'm in a good position, it is not impaired. So this is the concept of the impairment. If you remember that, any sort of impairment question will come in the exam, you will be absolutely fine. So let's look at the first one. We need to decide this asset is impaired or not impaired. So the first one, asset A, it says my carrying value is 12. Okay, fair enough. And the fair value or market value less cost to sell is 11 and value in use is 14. So between these two, I have to pick the higher one. So 14,000 is the higher, so we take this one. Now we have to compare between 14 and 12. So we can see my value in use is more than the carrying value. That means this asset is not impaired because my carrying value in the financial statement is 12, but I can still get the value for this is 14. So that means I'm not showing or I'm not overstating the value of the asset in the financial statement. So in the financial statement, I need to make sure I always show the right amount or the correct amount for the value of the fixed asset or non-current asset. So that means I'm not overstating, so it is not impaired. Impaired is like kind of a reduction of the value. So I can say like this asset is still have a more value than the carrying value, so it is not impaired. Asset B, again, we have a carrying value 9,000, and between these two, I have to pick the higher one. So higher one is 7. And if 5 and 7, so 7 is the higher one. So now we can see my carrying value is more than the recoverable amount. That means my asset is impaired by 2,000, isn't it? So I'm showing in my financial statement, asset is 9,000 carrying value, but actually in the market, I cannot sell it more than 7. So 2,000 is basically impaired. The value is gone down. So I say this is impaired. Next one, between 15 and 13, 15 is the higher. So it's more than 10, it is not impaired. Very simple. So you can see easy 3 marks if we understand it. All right, let's move to the next one. The next question, we have task 5, and this question is quite interesting question. I like this question very much. Consolidation, very much interesting. If you know this question, it will be very easy to get like 30 marks. There's a lot of marks for this question. A little bit workings you need to understand. Otherwise, I think this question is very, very easy, and obviously very quick you can get the full marks. The most interesting thing is like after you've done the question, you will know like you get the full marks or not. So if the financial statement is matched, that means you get the full marks. All you have to do, you have to know some workings. And the main workings you need to know that I'm going to explain to you now is a very, very important. Net asset of the subsidiary. Net assets of sub. Sub means subsidiary. If we remember this calculation, our workings, our life will be very much easy. We need to split it into section. The first at acquisition date. At acquisition date, so at the date of acquisition, when you buy the subsidiary, and at post acquisition date. Post acquisition date. Post acquisition date means at the year end date, after 1 year. All right. So the first thing we have to see, what was the situation of the subsidiary when I buy the subsidiary? So I'll look at their share capital. And if they have a share premium, remember that, consider both together, share capital, share premium, added it and make it together. So share capital. Then I look at their retained earnings. The retained earnings will be two different retained earnings, one at the date of acquisition and one at the post-acquisition date. The share capital normally is same. And the next we're going to look at a revaluation of asset, if there is any revaluation of the asset. Now, obviously, like if we understand this thing, it's going to be very easy, but also we need to remember if there is any impairment of the goodwill, we have to look at that as well. But anyway, for the time being, if you just remember this, share capital, retained earnings, and revaluation of the asset. Now, we need to look at the question first. So let's have a look. We need to open the question. And if we open the question, we can see some information here. Okay. So you can see here, let's quickly read the question a little bit. So you can see here, it says, BPLC acquires 60% of the issued share capital and the voting right of E Limited. You need to make sure they buy the voting right. It has to be the voting right. On 1st January 2011 for 80,000. So I buy 60% of E Limited by paying 80,000. So this 80,000, we called it consideration. When you pay something, we called it consideration. So 80,000 is my consideration. At that date means like the day I buy, 1st of January, at the date of acquisition. At that date, E Limited had issued share capital 600,000. So their issued share capital was 600,000. Retained earnings was 100,000. So remember, the retained earnings at that day means on the day of acquisition. So acquisition date and the post-acquisition date is not same. Remember that. The fair value of the non-current asset was 200, more than the carrying amount. So we need to add 200 because 200 is more than the carrying amount. The revaluation has not been decoded in the book of E Limited. So ignore any effect of depreciation. So ignore the depreciation. That's it. So this is my first information. All we need to do the first workings that you already read. 800,000 we paid for share capital, 600,000 plus 100,000 retained earnings and plus 200,000 the revaluation, and we buy 60% for that and we pay 800,000. Fair enough. So our information we need, we already have. Now we can go back to our workings and try to do some workings from here. This working is very important, so be careful with these workings. So the share capital, we said The question said the share capital they have 600,000. So 600 and 600. There is no new share capital issue, so we don't have to worry about that. Retained earnings 100 at the date of acquisition, and 200 is the revaluation. Now, revaluation will stay same as well, because if I revalue my asset at the date of acquisition, that means it will stay revaluation at the year end as well. But we need to be careful with the retained earnings. Retained earnings at the date of acquisition was 100, but we need to look at how much we have retained earnings for subsidiary at the date of post-acquisition or year end. So if you look at here, retained earnings for the subsidiary, that's the subsidiary E Limited. And if you look at the retained earnings, it's 150. So that is 150. So that means when I buy this company, when I buy E Limited as my subsidiary, the retained earning was 100, and at the end of the year, it is 150. That means within the year, I make £50 profit. Within the year, I make £50 profit. The day I buy it was 100, now 150. That means I increase, or together we increase £50. And in this £50, obviously, like the ratio is 60% and 40%. That means any profit I make as a parent will take 60% and subsidiary will take 40%. All right. So let's try to understand now. We added all of this. So we have 600 plus 1, 700 plus 200, 900. 900 is the total net asset. 900 is the total net asset of the subsidiary, and we own 60% of that. So how much is the value of the 60% of the net asset? So let's do that. 900 times 60%, and that will give you 540. 540 is the 60% of the value of the net asset. Now, how much you paid for that consideration? If you remember consideration, we paid 800 for that. So if the value of the net asset is 540 and we paid 800 for that, so why we paid some extra? So 540 is the value of the net asset, but I paid 800. So I paid a little bit extra. So 540 minus 800, how much I paid extra? 260. And this 260 I paid extra because of the company reputation, because of the company goodwill. So we called it goodwill. That's my first calculation. If there is any impairment of the goodwill, remember we have to minus the impairment from the 260. But this one don't have any impairment, so we are happy with that. All right, so we have this first calculation. And the next calculation we have here for the NCI, that is called non-controlling interest. Now, if you look at here on the post-acquisition, so you have a 6 plus 2, 8, plus 150, 950. On this 950, 40% belongs to the subsidiary. So we said 950 times 40%, that belongs to our subsidiary. And we said this is 380. And this is called NCI, non-controlling interest. NCI, non-controlling interest. So this is our very first calculation. If we remember this one, this will be very much easy for us to do rest of the question. First, we do the find out how much is the goodwill. So we do at the date of acquisition, then post-acquisition, then share capital, then retained earnings, revaluation. Only the retained earnings will be changed at the date of acquisition and at the date of post. The difference basically make the profit during the year. If I buy 60, 70, whatever percentage I buy, multiply with that, that gives me how much is the value of the net asset. I minus the consideration that I paid for that. And the difference, whatever I paid extra, that's because of the goodwill. And at the post-acquisition, so 40% is belongs to the other company, the subsidiary. So we called it NCI. So this is our first workings. All right. Now we'll start our question. The next workings we'll do for the retained earnings. This is another important thing, RE, retained earnings. When you do the retained earnings, remember, we take only parent only. Parent only. Do not take together. Retained earnings, we take only the parent. So we said how much is the retained earnings for the parent. If you look at the retained earnings, And you can see the parent return earnings is 628. Parent company is the company who is the main company, and the subsidiary is the company we buy. So 628. This is my return earnings for the parent. You can see here top B is the parent, E is the subsidiary. So 628. So you're going to say 628. So parent company 628. 628. And the next thing we need to remember, we only take the profit we make during when we are together. That means if you remember this calculation, from the acquisition date to the post acquisition date, we make only £50 profit. So from this £50, I have a 60%, right? Because I'll take 60% and the subsidiary will take 40%. So I said post acquisition profit. Post acquisition profit, and that is if I take 50 times 60% of that, and that will give me 30. So I'm going to take 60% profit from the subsidiary that we make together because I buy 60% of that company. All right, so I think this is our one workings. The next one we look at, there is another information that's also very important. We call it provision for unrealized profit. Now, if you have a look this one little bit, this part, it says during the next information, second information, during the year, B Limited sold some inventory to E Limited. Now, when we are one company, because we buy each other, when we are one company, we are together. So any profit we make each other, it is not like the profit for us. And we called it PUP, provision for unrealized profit. PUP, provision for unrealized profit. Remember that PUP, provision for unrealized profit, we have to take away from the retained earnings. So it will reduce my profit because we are now one company together. So profit making from each other doesn't make any sense, because if I make a profit from my subsidiary, this profit will be with me. So it doesn't make any sense. When we are together, we make a profit from each other. So we need to take out this profit. And if the profit is inside of the inventory, we have to take out from there as well. So you can see here, 70,000 we sold for to E Limited. And we can see the cost was 54. That means the difference, 16,000, we make a profit. The difference between these two, 16,000, we make a profit. And very careful, we need to look at how much the inventory still we have on the warehouse. Because if I sell to the outside to the people, so it is not a problem, I already get the money. But the only problem is after we are together, and if we still have some inventory left that I buy from subsidiary or from the parent, and there is some profit inside. So it says 1/4 of the goods is still in the inventory, 1/4. That means we have to divide by 4. So 70 minus 54, that gives me 16, divided by 4. That means 4 is the profit. We called it PUP, provision for unrealized profit. This is still inside of the inventory. So what we need to do, we need to minus 4 from the inventory. So from the inventory, we need to take it out. Also minus from the RE, retained earnings. Remember that. PUP, provision for unrealized profit, always have to take away from the retained earnings and from the inventory. That's it. All right, so we'll go back to our last workings, and we will try to do some workings together. All right, so if we come down to the workings, we have a few workings here. Let's try to do it. First, we do the goodwill. So let's do it very quickly. We know how to do it. The first one we do with the consideration. So we paid £800 consideration, and the non-controlling interest we have here, how much it is. So let's have a look how much is the non-controlling interest. So if you remember, from the 900, 60% is 540. Then how much will be the 40%? So 40% is the NCI. So 900 times 40%, and that gives me 360. 360. So 60% is give me 540, and 40%, that is NCI, that gives me 360. So we're going to say NCI, non-controlling interest, 360. And then we're going to say our net asset accrued. So the net asset value was 900. So net asset accrued 900. 6 plus 1 plus 2, 900. So minus the 900. And that gives you the goodwill 260. The goodwill you have calculated before. Now remember, obviously, like if you do other way, for example, if you do non-controlling interest first, then consideration, it's not a problem. As long as the goodwill you have 260, you are fine. You don't have to really follow all the format. As long as you have the right calculation, is absolutely fine. All right, so our goodwill is done. The next one is the retained earnings, RE. So we take from the parent only, remember that. So parent company we have here, that is B Limited. So B Limited, and their retained earnings 628. We have checked that before, 628. And after that, we have to look at our what's that called, the post acquisition profit 30. We have calculated that. From the 50 we will take 60% from the subsidiaries. We have 30 here, 30. So that is post acquisition profit. So we'll say A Limited post acquisition profit to B Limited. Yeah, remember that post is not pre, post acquisition. And finally you need to minus the PUP, provision for unrealized profit. So we call it adjustment, consolidation adjustment, -4, because this profit inside of our inventory and we have to take it out, and I already showed how to do it. All right, so we have our retained earnings. Then the next one we have here, our property plant equipment. We just need to add how much is the property plant equipment we have. So if we look at there on the questions, we have a PPE, property plant equipment, 3572 plus 684. So you'll add this to, that will be 4256. And we have some revaluation 200, we know that. So we have a consolidation, that is 200 revaluation. So we go there, 200, and that's it. The next one we have here, that is our inventories. So we need to look at the inventories. How much is the inventories we have? And after the inventories, we need to minus the provision for unrealized profit as well from there. So let's look at how much is the inventories we have. So we have 396 plus 202, that gives me 598. So we say 598. So 598. And the consolidation adjustment, you have to minus the 4 because some profit is included here. That's it, 594. So more or less, this is our story of our workings. Now we can go back to the question and we can do it really quick. So let's start with our goodwill. The goodwill we have calculated to 60 from the workings, property plant equipment. We have calculated 4456. That's from the workings as well. And then we have our next thing, that is inventories, that we have calculated on the workings, 594. Then we have trade receivables. So we need to look at the trade. This was 294 plus 121. So 294 plus 121, that's 415. 415. And then cash and cash equivalent, 150 plus 33, so 183. Just need to add subsidiary and the parent. Then share capital, we have 4,000. Remember that share capital and the retained earnings only for the parent. Very careful. Share capital, retained earnings only for the parent. For retained earnings, we have calculated that the workings, so retained earnings 654. And we have a non-controlling interest, NCI. If you remember, we have calculated that as well. And that is 380. So 950 times 40%. We did it at the beginning. The bank loan, long term, we have a 274 plus 186, that 460. And then we have our tax liability. So we have a trade payable. Trade payable, we have 268 plus 94, 362. Then you have a tax liability. And the tax liability, we have 268. And we have a closing, we have a 10. So 42 plus 10. So 52. Just need to add everything. And that gives me 5908. Now you can see here that, as I said, the financial statement has to match. This is the most interesting thing. So once you prepare this one, you can say it is a match, and you know you get this 30 marks easily. Because once it is matched, that's the only question you can say, like, okay, I have done accurately, and I'll get the full marks from here because I know I have done accurately because it will match. So this is very common in the exam, consolidation or consolidated financial statement. Either the profit and loss account will come or the balance sheet will come. You need to make sure you practice both. If you remember a few workings, your life will be very easy in the exam. And this exam will be very much relaxing because you'll know you've done everything properly. Because the financial statement or cash flow or the consolidation, everything you will know at the end of the result you've done accurately or not. All right, let's move to our next question then. The next question we have, question number 6. Let's try that. This question from the ratio analysis. And of course, it's not very difficult question. All you have to know how to do the workings. So we have here, let's read the question first. And we should have some information for question number 7. This is the additional information we have. And we always look at the question from here if you like to see. All right. So it says this task is about interpreting the statement of financial position. It's number 6, 7, isn't it? Let's have a look. What is the number 6? Didn't do number 6. Yeah, that's number 6. This task is about interpreting the financial statement using ratio analysis. You have been given the financial statement of B Limited for the year ended 31st of December 2011. You are now required to prepare a financial ratio to assist your manager in his analysis of the company. B Limited statement of profit or loss and statement of financial position are set out below. Okay. So you have a profit and loss account and you have a statement of financial position. All right. So let's have a look at the requirement, what we have here. So you can see here, they're asking you to calculate some ratios. So you need to calculate ROCE, return on capital employed. And you have a current ratio, inventory holding period, interest cover. Only 4 ratio you have to calculate. Remember that this question is very common, easy 8 marks. If you just know the formula, will get a very easy 8 marks in the exam. And the next question will ask you to interpret it, to explain what does that mean, the ratio. It's very common, they will ask you interpretation. So you need to make sure this is one of the easiest question you will have in the exam, the ratios. If you prepare well, you'll get a very easy marks from this paper. And as I said at the beginning, this is the only paper you can get a very good marks, 95 or 96 you can score in this exam. All right, let's have a look at this question and try to solve this one together. The first ratio you're going to calculate, that is ROCE, number 1, ROCE, that is return on capital employed. So R will go to the top, so R is a return, and return means how much profit you are getting. from our investment, from the capital we have invested, how much return we are getting. So return, and that means operating profit. And the CE, that is capital employed. That means how much capital we have injected in the business. So capital employed means total asset minus current liability. Total asset minus current liability means net asset. So we need to find it out, how much is the net asset. So another name of the capital employed is net asset. And the way you can find out net asset, total asset minus current liability. All right, so let's have a look. Operating profit. So we have operating profit 5894, 5894, and the total asset we have 91,233 minus the current liabilities, how much we have. So we need to look at the current liabilities from the question. So let's quickly look how much is the current liabilities. So we have a current liability here that is 32 and 69. So 3269. And we have to multiply by 100 because we're looking for the percentage. So let's do that. So we have 91,233 minus 3269. That is 87964. 87964. So 5894 divide 87694 and times by 100, and that will give us 6.7%. 6.7% is the ROC, return on capital employed. Number two, we have to calculate the current ratio. Current ratio is quite simple. Current ratio means current asset divide current liabilities. Current asset divide current liability. So we have a current asset that is 7518, and the current liability 3269. And this one we have to present like a ratio, so it's 2. So if we do that, it will give us 2.3:1. So how much is the answer? You need to put that, and this is always has to be 1. The other side will be always a ratio by 1. So what we understand from here, we understand if our asset is 2.3, then our liability is 1. That means we have enough money to pay our liability. So if I pay even £1 liability, I will still have something left. That is 1.3 I will still have left. So too much having current asset is not good, and too much liability is not good. It's always like 2:1 or 2.31 is a very good structure. But if it is like, for example, 0.9:1, that means my asset is less than my liability. So if I have anything in the company, I will not be able to pay my current liability. So the asset always has to be more than the liability. And ROC represent, if I invest this amount of money in the business, I'm getting 6.7% return. All right, the next one we have number 3. They're asking for inventory holding period. Inventory holding period. This is quite simple. We need to do inventory divide cost of sales. Inventory divide cost of sales. Now the inventory we have in the quotient 2817, and the cost of sales we have in the quotient. So let's have a look how much is the cost of sales. And the cost of sales we have here 19,154, 154. And as it is said days, remember that if any question asks you days, you have to multiply by 365. So that will give us 28 17 divide 19. 4 times 365, that gives you 53.7 days. Normally, we hold the inventory 53.7 days before the inventory is sold to the customer. And finally, we have interest cover. Interest cover. So how much profit we have to pay the interest? So how many times we can pay the interest based on our profit we have? So it's operating profit, and divided by interest or finance cost, whatever you said. So you can see we have operating profit, that is 5894, and our interest, that is finance cost, is a 1146. So I want to see, based on the profit we have, how many times I can pay off the interest. 5894 divided by 1146, and that is 5.1 times. That means the profit I have with me, I can pay the interest 5 times. So more it is always good. So in the ratio analysis, you have 3 types of ratio. We have a profitability ratio, we have a efficiency ratio, and we have a gearing ratio. So you need to make sure all this ratio, you know the formula and the explanation and the meaning of that, because this will be in the exam, and you need to make sure like you know this very well. All right, so we have practiced 3 questions today. Hopefully it will be helpful for you. And if you have any question, feel free to email me. And we have one more question. Maybe I'll try to make another video to explain about the ratio and interpretation, but it's not very difficult. I will show you maybe one question. If you understand one very well, any question will come in the exam, you will be absolutely fine, because more or less the same thing will be always exam. So if you practice well, this exam can be very good exam for you to get the good grade. And if you want to learn some practical work, like how to actually work, how to prepare the financial statement in real life in a software, and how to prepare the limited company accounts or payroll bookkeeping, you can try this site, the site I have made for the practical learning. So it could be very helpful for you if you want to learn the bookkeeping or the payroll or the VAT return or how to prepare the accounts. So I have put a few courses here. It could be very much helpful for you. So I'll put the link on the description. If you think it could be helpful for you, you can always have a look. And if you have any question, feel free to email me. Thank you very much, everyone, for watching. If you have any question, make sure you write on the comment, or you can email me. If you like this video, please like this video. Thank you.